Good evening. This is Ken Long from Tortoise Capital with a review of the weekly trading plan for July 14th, 2012. I'm recording this one and I'll hang it in the usual spot on YouTube. We've got some new regression line crossover charts to look at on the weekly based on popular request. So we'll take a look at those when we get to them. All right, so we've got a bullish normal market. It's at 55 out of 100 on the weekly RSI 14, so still in neutral zone. 10-day NDX puts us at 61 out of 100, so we're also in the middle of that range, so it's neutral. Percent stretch above the 200-day moving average at 4.52%. It's about the same place where we were last week, so still bullish, coated white. Slope of the 50-day moving average got a little bit weaker, bearish red. So we haven't had the explosive follow through yet that the bulls are hoping for. ADX 14 is at 15.0, which is weak, and that's actually going to be promising for the long side based on Friday's price action. We're going to see that we have potentially a grinding upward bull move developing. ATR percentage has declined a little bit more to 1.33%. Based on the ATR percentage of 100, that puts us into the middle of white normal. So bull normal market, market's neutral short term. No changes to the 26 and 13 ETF blended monthly rebalancing. I should note that in preparation for the next, I got a workshop next weekend at IITM to go over the core trading strategies, which includes blended monthly rebalancing. I've hired my son to do a little back testing research for me, and he's gone through about 1,000 different variations of the rule sets for blended monthly rebalancing with different portfolios and different rules, and he's done some pretty good work. Also looking at the bear side opportunities over the last 10 years, so we're trying to come up with some short side rules to consider, and I'll be reviewing that later tonight and tomorrow. But he just done such good work. I think I'm going to have him write an ebook and sell it for a nominal fee to encourage him to keep doing that kind of good work. So I'll let you know more about that. Next reevaluation on blended monthly is due on or about 1 August. Under ETF 2, theoretical exposure is at 20%. The model portfolio is at 50%. And as Robert Gardner points out, it's been pretty stable, not very much whipsawing in that at all. It's probably a reasonable place to be considering the vulnerability of the indexes right now. Moving on. Here's looking at the blended monthly rebalancing now. The top three positions, TLT, IYR, and IWM among the 13 ETFs, which is good news, I think, for the U.S. and the growth on, or the risk on trade, that IWM is moving up the ladder. We've seen in previous months where that's been SPY and Diamond at the top, and now that we've got IWM coming on board, that could be a return of the risk on trade. Technology has fallen off from its leadership role. For the longest while, last 2 months, it's been the strongest of the U.S. indexes and is now the weakest. It is actually slightly below the other U.S. index. What's interesting is it's actually even below EPP, which is slightly, I find that interesting, even though it's a cash in EPP, it's actually outperformed the U.S. technology. And not so much that it's outperformed it lately, just it has underperformed less than technology. You can see the contribution of the 3-month performances of each of those. And so that gives a slight edge to EPP. Conversely, if you take a look at that as an opportunity to buy strength in a strong index that has pulled back momentarily, then technology should be on your short list to watch. Kind of a price anomaly here between the Qs, which have lost 4.5%, and the small caps, which have gained 1%. That's a a divergence in the risk-on trade there in the U.S. So that deserves some attention. And then the rest of the globals taking up the rear, and Latin America continuing to be the weakest. Inside the 26 ETF portfolio, mostly the same kinds of insights. And what we have here is emerging market bonds have, because of their interest, have crept up into the top. They're still among the top 3. That's been a pretty good performer. The Midwestern heat wave has really put a premium on food products, and so DBA has just been a rocket ship here. You can see it's earned more in the last 3 months than it has in the last 6 months, and that's part of this acceleration in the recent term. Financials still in a cash position, but doing better than technology, oddly enough. The globals are lagging on the expanded portfolio, and Brazil and the BRICS and China. Latin America, the bottom 4 positions, that's all the traditional strong ones from the last couple years, have really taken it on the chin here. Next, health check. Vertical blue lines represent 10, 20, and 30 days worth of look-back period. The horizontal purple lines reflect price targets that have been resistance in the past, and which remain profit targets for us now. And important decision points really for the market about whether it's going to continue to grind up. The red lines represent support levels from previous intermediate term swings. The 5% and then 10% pullback boxes reflect 5 and 10% pullbacks from the swing high of 142, which was achieved, in late March this year. Those two price levels at 135 and about 128 reflect definitions of normal pullbacks in this bull market. Between 0 and 5% would be a noise move, and that's about where we are right now. We're back up into the noise of the bull as it starts emerging from the river, which has started to roll up, as you'll see. And then between 5 and 10% reflecting ordinary pullbacks in bull markets. It came down and tested that one time when it bounced off the 200-day moving average. It's been a choppy move up, but it has been a move up which reversed this downward trend that we saw in the previous 3 months, months 4 through 6, or days 31 to minus 60, I should say. And you can see that the river has started to turn up, as indicated by the dotted line in the middle, the Bollinger Band mean. The black line in the center is the 30-day regression line. You see the slope pointing up, and that's a good thing. And the outer black lines are the regression channel formed by the maximum excursion from that regression line during a look-back period, and that defines the current working boundary of normal. Going forward, we've extended that regression line using a Andrews pitchfork, which tells us what the expected path of that trend should be, provided nothing fundamental changes underneath. So it's really, I would say, scheduled to get up and test 142 sometime in the next month, and the next target being about 138, which is now just like at the 75-yard marker here on inside that channel. So we could expect to test that probably, in the next 5 to 10 days. And then that's really the first hurdle that it's got to get through. What we've seen here is a swing low at 127-ish, higher high, higher low, higher high, higher low, and now we've put in this second higher low at the Bollinger Band mean, right where you would expect it to find support. It's been finding support. So now the next test is for this to continue. We would expect it to see it getting above 138 now, and then from there it's a short walk to test the swing high at 142. It has to clear and hold 142 to really say that the bull is back. That would sort of be a surprise to people that want to sell in May and stay away, and that's why the market could very easily do that. You can see the 200-day moving average outlined in red here, and everything in the shaded red area is priced below the 200. That's sort of how close we are to re-entering the bear. If you now take a look at the ADX up at the top, what we've got is ADX down around 15 and a generally upward grinding move. And what that says is that there is technically some room for it to grow into a longer-term positive trend and still not violate historical norms. So it could definitely get up to 142 and beyond without getting to an extreme on ADX. And that's because this upward move has been so choppy. That's kind of characteristic of a market that is putting in an intermediate term bottom here at 127. You could talk yourself into seeing the cup and handle formation here, and so definitely breakouts above 138 are to be followed and supported, and certainly if it gets past 142. This remains a trader's market, however, with lots of volatility and pullbacks, and so respecting the river and not chasing the breakouts, but being postured in them at normal support levels like we saw on Friday. That was a perfect frog day where we had a gap up opening and then it took off and just went. And so the leapfrog and the quick frog were both definitely rewarded on Friday. And I am inclined to reward follow through. Basically, if we can get above 136, then it's a test of 138 and beyond. So that still is I have a directional bias to the upside here. However, if it fails below 133, then the next target down at 131 is a significant intraday move, and you can see just by the size and frequency of these big red directional candles that one-day counter trend, intraday trend has been a very lucrative one, but not one that you want to hold overnight. There has not been follow-through in the last really 30 days. The last time we saw follow-through was 40 and 50 days ago when you had multiple losing days strung together. However, the times have changed a little bit here, and I would take any downside trades one day at a time with no interest in holding overnight, because that would definitely be violating the primary trend, which is grudgingly facing upward. So I'm still bidirectional on this one, but with an upward lane. Let's see. Taking a look at the other indicators here, the percent R is right in the middle of the range. The jaws of PPO closed down. They're open to the downside. However, it's trying to put a cross back in. So that's really inconclusive right now. ADX, though, is the one that really I think is significant. The bulls voted strongly on Friday. Plus DI is now greater than minus DI, and the ADX line itself is in a position where we could definitely see price unfolding to the upside over the next 4 to 6 weeks. Okay, moving on. Next up are the 10 major indexes of the ETF2 model. You see 2 out of the 10 are on a buy signal. That puts us at 20% invested, 80% cash in the theoretical model. The actual model, the model portfolio, was at 50-50 because those 10% trailing stops have not been hit. So we stay in the strongest of the strong there in choppy markets, and that's been a useful technique to reduce the whipsawing. Right now, the SPY is better than EFA, with SPY at 57, EFA at 46. So it's still a market that favors the U.S. Inside the U.S., the strongest indexes are now the S&P, and this should now actually reflect IWM. And I just noticed I mistyped that. So it should be SPY, then IWM, then technology, then the mid-cap. So IWM is moving its way up the model. Next up, world market model. Starting off in the U.S., everything above average except the mid-cap techs. Latin America, emerging markets weak. Asia less Japan less weak. All of Europe weak. Inside Asia, in the countries of Asia, China and South Korea are the laggards. Malaysia, Singapore, Hong Kong remain strong. In the Western Hemisphere, Mexico burning its way to the top, but Brazil has been a long-term weak spot, even weaker than the rest of Latin America. That's one that maybe the value players might be interested in. This is putting in a pretty harsh sell-off bottom there. All of Europe weak. Treasuries and U.S. real estate remain exceptionally strong, as are corporate bonds. Gold and silver are being tested right now for the checking for weak hands, I think. Inside the global and U.S. business sectors, it's still the defensive plays, as it has been for almost 4 months now. Staples, utilities, healthcare, very strong within the U.S. and globally. That's the XLPs and the XLUs of the world. Finance has started to get a little better. That's maybe one to watch it starting to emerge back towards the top. That's one to keep an eye on, although it's still below average in the globals. But right now, it's still the defensive plays, certainly. Moving on. I want to zoom ahead to regression line crossover. This is a new chart for us, so I want to spend a little more time on that one. All right, so what I've got here is just a prototype chart, and it's basically SPY, then the small caps, IWM, long-term treasuries, TLT, and then gold, GLD. I just, the lineup may change, the size may change a little bit, but I wanted to just get a representative sampling in here. And what you see on each one is I've taken price off the chart, and I put a 30-day Bollinger Band in the thin lines, with the red line being the 30-day simple moving average, and then the outer two lines are the Bollinger Band to create the river. And then in the usual way, I've got the 10-period regression line, which is a good proxy for price, reflected as the thick blue line, and then the 30-period regression line in black. Now, what I want you to notice is just how quickly the 30-period regression line changes direction. Regression lines tend to be much quicker to respond to that change in trend than do the simple moving averages. So if you just compare, for instance, the black line to the thin red line, you can see the difference between a 30-period regression line in black and a 30-period simple moving average. In fact, you may want to pay close attention to those crossovers. When the regression line dips outside of the river and then crosses the Bollinger Band mean, look what happens next. So you can see where I have indicated right here in SPY, a regression line, simple moving average crossover of the 30s, 30-period regression line crossing the 30-period simple moving average. And that was good all the way up to here, which gave you an early warning about this that 10% pullback. And then recently, a couple weeks ago, with the regression line crossing back the upside. So what we have right now is the 30-period regression line out of the river, pointing up, while the 30-period simple moving average has rolled up. And that's why I'm cautiously optimistic here about SPY. And I think there's a real opportunity to get ahead of the game. If it gets above 142, everyone will look back and see this as a buy on dip opportunity. But I think what we got here is the potential to front run. You can see how choppy the 10-period regression line is, so don't chase it, but buy value when it's after periods of sell-off. You'll notice that IWM is in the same position, but it's actually a little stronger than SPY because the 10-period regression line has not come as far back into the river as it has in SPY, and the 30-period is definitely out of the river, and the river is hooking up. Of course, but you can see treasuries have been on a tear here lately, and they're well postured. That if there is failure in the indexes here, been a lot of people putting money in the treasuries, and I think that's a reflection of money coming out of Europe and the emerging markets and going into treasuries en route to getting into the equities. So among the equities, it's definitely the U.S., but there's been a very strong move that caught some people by surprise in treasuries. There was, just among our own members, there was a lot of people groaning about blended monthly rebalancing that put us back into treasuries at the start of the month, and yet that's been a pretty good move, almost an equity-like move. So that's how I'm looking at it. Now gold, you can see, is pressuring its downside. The regression lines are down, getting ready to come out of the river, and the river itself is pointing down. That's troubling to the gold owners. And but what I like is that gold around 150, GLD around 150 has found a lot of support previously, and that's an area where I've bought in the past and been happy to trade these swings on the way up. So that's the regression line crossover. Quick look at 4 indexes. If that proves to be handy or useful, I can add more of those pretty easily. I've added a worksheet to the spreadsheet, and once I get a few more indexes built in there, it'll provide a way to check 20 of your favorite ETFs using the RLCO lens in conjunction with the Bollinger Band. And I think that's a good way to stay on top of intermediate trends and opportunities. Okay, moving on. The volatility has actually declined a little bit this week, as using a measure of the 30-day standard deviation. You can see that it's actually rolled over a little bit. For a long while, it was up in volatile, but we didn't get that surprising, shocking news that might cause it to rocket up. And so instead, volatility is actually coming down. That's actually a piece of the mosaic that favors the long-term slow grind up that I described using the market health check. So that's one to keep an eye on. All right, so that's the weekly strategy. I'm going to shift over to the daily. Give it a second to let that come up on your screen. Okay, so here we have the daily. Let me get that a little bigger for you. I'll repeat the top row. We have no signals in the overreaction and channeling. You can see the daily pivots in the usual place. Volatility has actually declined here these last 30 days and is now just slightly above the 6-month normal. ADX you see is low at 15, and that's been a place where long-term trends have started. You can see this little move last time was where the bear pullback here about 2 months ago occurred, and then the previous bull run up came out of low ADX. So that's got Chuck LeBeau salivating. You can see the 10-day max pain candidates: Hewlett Packard, Alcoa, Caterpillar, DuPont, Intel. The losers in the ETFs. The VIX, gold miners, semiconductors, metals and mining in China. The winners have been the XLP companies of the world, the large cap, mature, dividend paying, core staples. That's Walmart, Kraft, Verizon, Johnson & Johnson, and Merck. You can just own them with XLP if you want. No pattern trades per se, although quite a few on the auto framer that they offer a 2-to-1 reward to risk based on trade location. Let me correct myself. There are a number of 551W patterns in play here. Emerging markets, Japan, technology, Brazil, and tech. That's very positive for things that used to be weak that had one good day. So a second day of momentum would be possible, like, for instance, Brazil. We'll take a look at Brazil. Technology, and that's both the XLK and the Qs. That's U.S. tech. Those are worth looking at because they had been previously very strong, so maybe this is a buy-on-dip opportunity. We'll look at all three of those at the 551W. Among the large caps, General Electric, 3M, Coca-Cola. I think, man, you got to love Coca-Cola at this time. Being able to buy it on dip should definitely be part of your strategy as a trader. And then AXP, American Express. I would add to that the strength we saw in finances with XLF starting to move its way up, and then you add in AXP as a finance leader. That's one that we'll look at as well. So I think that's 4 good ideas for swing trading and intraday trading in the week ahead. And that's just based on trade location as well as a robust pattern. Dow 30 tactical. Notice that everything on Friday was decisive. Only one doji, and that was McDonald's. And it had the courage to actually be the percent loser on Friday, despite Friday's big day up. Bank of America, Caterpillar, 2 big days up there. 6% in JP Morgan. That's part of that strength in XLF that we're noticing there, right? And I would say AXP actually lagged that a little bit, bringing in only, and it's got a fraud quality number of 3.2%. So the strength in the bounce there on finance didn't really hit AXP. So I think you could play that a couple ways. You could look at Bank of America as a max gain, and it was a percent winner on Friday. And you might look at JP Morgan as a follow-through candidate too, with its percent gain. So there's some possibilities there. That's the 4 551Ws we talked about. And only McDonald's as a doji candidate. ETF 30 tactical summary is up next. And only 2 doji candidates there. That's silver and treasuries. And a handful of 551Ws as well that we saw earlier. And then 5 auto firmers. The big strength you notice in the ETFs was on XLF that brought in 2.5 or 2.8% as a sector. So that's why I think we got to be interested in follow-through trades on Monday among the financials, because they have been lagging for a while, and they're the first one to turn the corner ahead of the basic materials and those guys. So that could be the first move out of defensive plays over into financials. That's something to be aware of. Market mosaics, we'll just take a look at the powerful move on Friday, which brought it back to the 30-period regression line here. And the 30-period regression line compared to its 10-day moving average has come back to the 0 line here. Now, that puts this whole move in jeopardy. You can see that while there has been generally upward movement, it's slowed down here in the previous 6 or 7 days, and that's what brought the regression line slope back to its 10-day moving average. It has got to follow through here and test this in a hurry, otherwise that entire move is now suspect, and it looks like 137 in that case would be the swing high. And then what we'd have is, in that scenario, failure at 137 and then a sell-off back down towards 127. And what makes that a real possibility is how choppy this move up has been. This did not have the same flavor as that last move that took us up to 142, which once it got going, it went. What we've got is a lot more chop here after that 10% pullback. So it's got more to prove. It's failing at a price pretty close to that 200-day moving average. So don't be fooled by my positive comments or my upward bias. There's some real weakness in this market, and that's why it remains an interesting trader's market here. Okay, so moving on. Looking at the z-scores, regression lines. What I will tell you that what this tells me is we got to be very careful with this fragile bull that we're in. We're still very close to the 200-day moving average. We're right at the top of this of the river in the Bollinger Band here, and that's a natural place for it to fail, like it did the last time it failed at 142. So it got to 140. It got to 142 in March. It only got to 141 in April, and then that presaged this big fail out of the river, which was the primary trend for a long time. So we've had this choppy move up. The river has slowly started to turn, but this is a natural place for it to fail. And why do I say that? Well, the 10-period regression line has already failed down to the bottom of its normal channel. The 30-period regression line slope failed at one standard deviation above the zero line. This is a normal place for it to fail. The last time it failed here, it had a 10% pullback to 127. So that's why it's very, very vulnerable here. The 10-period regression line has already failed, like you said, and now it's at the boundary of extreme normal downward move. And that tells you one of two things. It's either going to rebound sharply like it has the last two times, or if it fails here, it can fail much more sharply for another week. And then that's where you get those big rundowns. And now the 90-day regression line is bottom of its normal channel. And now this is where really the longer-term trend could actually cause it to move up here and provide this grudging support upward. But I judge the market to be right at a very important turning point in this upward move right here. And there's an equal probability of going up or down, and the move will be significant in either direction. It either gets up, 7 points up to 142 to test the swing high, or it fails quickly down to 128 and it gets right into the 200-day moving average again. So that's why this is a really good trader's market, and I am not interested in holding things overnight, but I'm taking advantage of these very directional one-day moves. So keep that firmly in mind here. I have an upward bias, but it is fully cognizant of the strength of the downward story as well. And that's why the ADX is so low. There has not been follow through. It's been a grinding market. This is a trader's market. You can see that reflected in the BMR system, which has only a 20% exposure in the world. And even in the theoretical model was only 50%, and that's with the favored defensive plays in the U.S. large cap. So this is not, by no means are we near the end of a bull move. We're early in the potential bull, which is why you can use judgment and good risk management to protect you against violent moves in either direction. If you take a look at that last bull move up, look at how smooth that thing tracked the upper Bollinger Band. It was not a choppy market at all, whereas this move up has been very choppy. It is just now starting to try to hug that upper Bollinger Band. So again, we're early in the move. Be careful. Everything I want to cover on the daily. We're about 45 minutes into this, so what I would like to do is just take a quick look at those four charts that we saw, or the symbols we looked at before. The first one was, let's take a look at the NASDAQ, so the Qs. And again, this is a perfect 551W. So what you have is from 5 weeks ago, the price is up. The move from 5 days ago is down. The high 5 days ago. And you have 1 day of positive momentum. And so that breakout from above yesterday's high, with the stop below the swing low, and you've got a price target up here to go after. That's a reasonable one-day trade, a nice trade frame. And again, if it can get above 65, then it's all smooth sailing, because the last move was up here around 68. So that's the cues. We should probably see about the same thing in XLK, which is the market's the S&P sector fighter for tech. And again, you can see almost identical pattern. Now let's take a look at XLF, which was that stealthy financial move. Take a quick look at that one. This looks even better to me than technology. Absolutely better, because you have you still have the higher lows. 1, 2, 3 higher lows off the swing low, but it's a lot closer to testing that swing high. This is a very stealthy little move here. It found support where previously it had found resistance, and so I really like that in finance. Really above 14.8. Hey, there's nothing to stop that from going to 16. That's an automatic entry, and that I think could be a good swing trade, because it's above. You can this above 50, which is this blue. It's above the 200, which is pointing up. This is something that looks like it's going up to me. Stealthy move, brought to you by your friends at the ETF2 database. Let's see. Let's take a look now at EPP. That's at Asia less Japan. That's pretty darn stealthy too. I really like that as well. Support, what used to be resistance is now support, and that sucker goes to 43 pretty quickly. Watch, any kind of news. This is not Europe. Any kind of news here, this is very favorable. I really like EPP, and you can see that's better. Blended monthly rebalancing finds that to be better than the Qs. A nice channel here. You're still getting it early in the channel, and that's going to go to 44. And then on the downside, if you get failure, 38.5 and then 36 are the two downside targets. So that's a really nice trade frame for a swing trader as well, in either direction. That's very favorable on the upside. Okay, so that's everything I wanted to cover today. If you like the looks of those RLCO charts, it's a simple matter for me to add those to the dailies. I kind of like them. I'll be looking to add, I think, a few more indexes to give us some insight, but be interested in your feedback in these days and weeks ahead. Next weekend, core and global long-term trading workshop at IITM. And again, my son's finishing up his little ebook on the research on that. I think we want to encourage the young man to keep doing high-quality research like that. So I'll share the opportunity with you when we're done. So that's everything I got today. I'll hang around for a second or two. We're getting ready to go to the dog park and walk these dogs. Take good care, and I will get this processed and hung in the YouTube channel in the usual way. So take good care, and we'll see you on the rebound.